are in listen-only mode.
All right, so we'll go ahead and get started. Can everyone hear me?
Yes.
Okay, perfect. Welcome everyone to our Managing Credit webinar. I'm Natalie Rosado. I work at the Women's Business Development Center, and I'm the Associate Director of Latina and Early Childhood Education Entrepreneurship Programs. Today we're going to be hosting a webinar with Madeline Cruz from the Resurrection Project. She is a senior financial coach and specializes in helping her clients better their credit and repair their credit. So we're really lucky to have her. She's a wonderful expert on credit repair, and she's going to share some information, some tips, and just a lot of different information on how to repair your credit and how you can better it, which, as a lot of you know, is a vital part of becoming a business owner and trying to get funding for starting a business. So I'm going to go ahead and hand it over to Madeline, and she can introduce herself and the webinar that she'll be presenting today.
Perfect. Thank you very much, Natalie. Please let me know if you're not able to hear me. Also, I apologize. I am getting over a cold, so if I'm coughing or you hear sniffling, that's why. But thank you for inviting me to do this. I work with the Resurrection Project. I am, as you mentioned, a senior financial coach. And part of what we do is working one-on-one with clients who are looking to improve their credit, help manage their budget, their monthly budget, their expenses, their debt, increase savings. And that's basically what we focus on when we meet with people one-on-one. But we also do these presentations in group setting. And usually we do them in person, but this is going to be probably my second time doing it in a webinar. So I appreciate the opportunity, and hopefully it is just as effective. So what we're going to hope to do is hold questions until the end, because most likely I will answer whatever your question is, hopefully by the end, and we'll have some time at the end to go over them. I believe you're going to be able to put them in the chat, and then I'll be able to look at them at the end. So I'm going to go ahead and get started. I will also mention this is a presentation that we use for our presentations in person, so some of these things may not pertain to us as we're not seeing each other face-to-face, so I might skip over them. So I'm going to talk in a little bit about the Resurrection Project and who we are and what the department that I represent do, but I do want to talk about in today's session what it is that we're looking to talk about, so you have an idea. So we're going to learn about the importance of credit, and it's important to mention that we're talking right now about personal credit, right? Personal credit is going to be your foundation to build upon for future business credit. So right now we are talking about your personal credit, how it impacts your wallet in your future, learn about the credit bureaus and their function, learn what a credit report is and what makes up a credit score. Some of these things are a little bit more basic, but we will go over them. Learn how to create and maintain a positive credit history. Learn how to improve your credit, determine where you fall as far as what your credit score currently is, if you know, what is the range. Learn how credit cards function. Usually this class is about 2.5 hours, so some of these things at the end we may not get a chance to go over, but I will at the end give some dates for anyone who is local. If you are looking to either meet with me one-on-one or attend the full session, there are dates that we do monthly. And then lastly, how to protect yourself from fraud. Don't mind me. So the Resurrection Project, we actually celebrated 25 years of existence last year in 2015. So we are a nonprofit organization, and we are based out of the Pilsen neighborhood in Chicago. Here is our mission statement. We are a community-based, not-for-profit organization. Our mission is to build relationships and challenge people to act on their faith and values to create healthy communities through organizing, education, and community development. So in the 25 years of our existence, we actually do quite a lot within the community, and here's just a graphic to kind of cover all of our bases on everything that it is that we do. Real estate development, affordable housing, college student housing, which is actually one of a kind in the U.S., economic development, which is very similar to what WBDC does, community organizing, financial education, which is what I fall under, what the department that I represent falls under, and that is what we do in a nutshell. Now, within the department that I represent, we call it financial wellness. We cover all of these services: home purchase counseling for people who are looking to become homeowners, financial education, which would be what we're doing today, financial coaching, which is what I do with people one-on-one, foreclosure prevention, which is for people who are already homeowners and are in fear of losing their home. And we also have what we call TRP Realty, which is our realty services. Most of what we do, most everything that is listed here is done absolutely free. So home purchase counseling is free, financial education is free, financial coaching is free, foreclosure prevention is free, and actually TRP Realty is also to no cost to the client. Now, once you're meeting with one of our professionals when it's coming to home purchase, foreclosure prevention, and most definitely financial coaching, these are the type of things that we are looking at. We help you manage your money and debt, develop a spending plan, learn about consumer credit, which is part of what we're actually doing today, money and debt management and budgeting, if that's the case, avoiding foreclosure, navigating the home purchase, if that's the case, understanding your loan options if you're looking to become a homeowner, and with that, learning about down payment assistance programs through our TRP Realty. So that's an intro to the Resurrection Project and a little bit about what we do and what my department does. Now let's get more into the meat of what we are talking about today. So also, let me check here. All right, hopefully everyone's being able to hear me well and I'm not going too fast, but if I am, please leave that in the chat. All right, so we start the discussion when we're talking about credit and your personal credit, having us all ask ourselves, if you were to lend money, let's say you're going to lend me money, what kind of things would you want to know about me? So you just met me, and in this case, virtually met me, you haven't even seen me, but you know that I work for the Resurrection Project and what I do. If you were going to contemplate lending anything to me, what kind of things would you want to know about me, right? And that's kind of to put ourselves in the lender's shoes and in the thinking cap of what a lender is looking at when they're looking at us to determine if they're going to extend credit to us, right? Usually when we do this in a class, people start mentioning things like, you know, I want to know that you have income. I want to know where you work. How long have you worked there? Things that make sense. So just ask yourself, what kind of thing would you want to know from me if you were even going to contemplate lending me any money without knowing me really other than what I say of who I say I am, right? So in thinking like that, we're going to talk about the 4 C's of credit, what we call the 4 C's of credit. So these are the things that people usually end up saying to me out loud in different words, but this is basically what they end up mentioning. Why? Because these are the things that are going to assure a lender that they're going to want to extend credit to someone and that they're going to get their money back, right? So the 4 C's of credit: capacity. What is your ability to repay the loan? So what is that then? Proof of income, right? Your ability to repay the loan. Character. Will you repay the loan? Have you used credit before? Do you pay your bills on time? And we'll talk about what is used to determine your character. Collateral. If you fail to repay your loan, is there something of value that you agree to forfeit, right? So usually in any type of transaction, the lender is going to want to see what is it that you will forfeit in case that you do not comply with the terms. And capital. What are you worth? Do you have other assets such as a savings account, car, certificates of deposit, anything else that can be used to repay the debt? So when you're coming up to the table, what is it that you're coming with already? Okay, so these are the 4 C's of credit, and it's important to understand them just because, A, if we put ourselves in the lender's shoes, these are the type of things that we would want to know if we're going to extend out credit. But B, it's important for us to understand how we're being looked at and what is being looked at so we know how to better present ourselves, right? That's the whole point. And when we're talking about the goal in the long term being a business and potentially business loans, we need to know that we are first being looked at as ourselves, as individuals. And so that's why it's so important to know how our credit needs to look like and what is it that we need to improve if it doesn't look like that already. Okay, so it's important to know what types of credit it is that you can take out, what type of accounts is it that you can have, that you may already have, and how they are categorized on your credit report. So the two types of credit that you could have are either installment or revolving. And installment loans are anything like car loans, mortgage loan, secured loan, personal loan, things that you are making in literally an installment payment for monthly with a fixed amount. It has a loan term amount, at which time you will have finished paying that loan, right? So we all have examples of something like that we have paid in the past or are currently paying. Then revolving accounts are what we call credit cards. Revolving accounts because it is a certain amount that you have access to. Once you use it and repay it, then you again have access to it again. So it's revolving. It's never ending. As long as you continue on repaying it back, you then again have access to it once again. So these are the two types of credits that you can have. And usually it is recommended that you have a good mix so that you have at least one installment loan and at least one revolving account on your credit report, because then it shows that you're able to manage both types of credits hopefully well. That's what you're trying to show on your credit report. And it's important to know that installment loans like car loans, anything that you're making an installment payment on, so it could be something from Best Buy or something like that, it helps you while you're paying it. Once you're done paying it, it'll show up on your credit report as positive history, but it's no longer doing anything for your current score. Sometimes people don't know that, and the only type of credit they've ever taken out has been something through a store like Best Buy or Sears. And while they're paying it off, if they've paid it off well on time, then it has helped them. But let's say that you have a loan or took out credit with Sears 10 years ago, paid it off, and then after that have not done anything else, and you thought that that was enough. Unfortunately, after you're done paying off that installment loan, it no longer is helping. So that person may end up coming up as not having, excuse me, as not having any credit score because they don't have anything active that's actually being paid off right now. So I mentioned that because I've seen that a lot. Sometimes people don't know. So it's important, again, to have a mix of installment and revolving. And when I say mix, that literally means one of each. You do not need any more than that. But let's say one of each so that you know that if once your installment loan gets paid off, you still have your revolving account, which would be a credit card, a secured credit card that you continuously use, and that will never end unless you close it or they close it for you. Individual or joint credit then refers to how an account shows up on your credit report, if it was taken out as something individually or if it was taken out as something joint. So one of the things that I usually like to ask is how many people know the difference between that. It's pretty self-explanatory, right? Individual just means you, joint means with someone else. What's important to know is that at the time of taking out a loan, whoever signs is who's financially responsible for it. So that goes to say that if you signed or co-signed for someone, that means that you and the other person are equally responsible for that debt. That doesn't mean if person A stops paying, then I'm responsible. Or if I happen to be person A, you know, person B has to pay if I don't pay. It means you're equally liable for that loan, for that amount. Now, usually when it's joint, there is a understanding between the parties involved of who's going to pay or not. Just know that it will show up on your credit report because you signed for it, and whether it's getting paid by you or the other person, it still impacts your score. So that's why it's important to know that when we are signing off on something, especially if we're not the ones who have control over if that's being paid or not, the type of impact that it can have on our credit report. If it continues on getting paid on time, then it absolutely has good impact on your score. If you're not the one that has determined that it's going to be paying, just know that if that person stops paying, not only have you been liable the whole time, but it will then start impacting your credit report or your credit score negatively as well. We then start going into the actual credit report. And what does that look like? What shows up on your credit report? Okay. So for any of you who have already taken a look at your credit report, sometimes credit reports can be a little confusing to take a look at depending on what it is that you're looking at. You could have taken it out directly from the credit bureau, and we're going to talk about the 3 credit bureaus, or maybe it's a report that has been printed out for you. Our organization does a tri-merge, so we're able to pull from each one of the credit bureaus, so we're able to see the 3 scores. And when we pull your credit report, just as anyone else or you yourself pulling your credit report, it does not have the same type of impact as if a lending institution or financial institution were, if they looked at your credit report, right? Because if you're taking a look at your credit report yourself, or an organization, nonprofit like ours, we're taking a look at it to review, not to determine if we're going to lend or extend credit to you. As soon as you sign off on someone taking a look at it, because they're going to determine if they're going to extend credit, so a credit card at a store, or if you go into a bank, any type of loan, then that starts to actually have a negative impact on your score. It can deduct by a couple of points. So I mentioned that because it's important to know, as long as it's you looking at your credit report or a nonprofit like ours, we can take a look at your credit report as many times as we are able to, and that's not going to have a negative impact. Now, here's what then shows up on your credit report. The credit card or the credit account information, the company name, the account number, if not the entire number, then at least the last 4 digits or last 6 digits, the type of account that it is. So is it revolving? Is it installment? Is it joint? Is it individual? The date that it was opened, the credit limit that you have on that account, the balance, the past due, and the dates of when those past due happened and how often. Excuse me. Now, we already mentioned every time that somebody takes a look at your credit report that is determining to see if they're going to extend credit to you or not, not only does it impact, but it also shows up on your credit report. So it'll tell you in the last 90 days, these people looked at your credit report. So that's a good thing, and one of the last things that we talk about is how important it is to continue looking at your credit report yourself at least once a year, because this is going to determine if there is any type of fraud or anyone using your information or trying to use your information. This will be an indication. If in the last 90 days a company shows up that you have not gone to, then this is a red flag that somebody's going out there trying to take out credit under your name. Also, we want to make sure that we keep that number to a minimum, right? So unless you absolutely need the credit, so a loan that you need or a credit card that you need because you are trying to establish yourself with your credit, we want to make sure that we keep the inquiries to a minimum, just because we know that each time that somebody takes a look at our credit, it looks negatively on us. What else shows up on your credit report? Your personal identification information, your full name, your current and previous addresses, your last 3 reported employers, any public record information, so obtained from local, state, and federal courts, collection agency account information, so any account that now is with a collector will show up as well. And then here's the information for the 3 credit bureaus: Experian, TransUnion, and Equifax. So here's their website and their phone number. Most of the time, and a little bit further into the presentation, we're going to give a website where you can actually obtain your credit report for free once a year, and you're able to pull from all these 3 credit bureaus. It will not give you a score. It will ask you to pay for a score, but you are able to see the information, like the accounts that show up, who has looked at your credit report. Everything like that you will be able to see for free once a year from each one of these. And you don't have to pull all of them at the same time. So you can, at the beginning of the year, pull Experian, middle of the year, pull TransUnion, and end of the year, pull Equifax if you want to, or you can pull them all at the same time. The only thing that it'll ask you to pay for is if you actually want to see your scores. Okay, so here, let me make sure. Yeah, sorry. So here we talk about the reasons that it's important to have good credit. Hopefully by now, most of us already know or have encountered a situation in which we have needed credit, but the more time goes by, the more and more important having good credit becomes, for reasons like housing. And in housing, we don't only mean purchasing a home, but renting. Depending on the neighborhood and community that you live in, it may be required for you to submit a credit report, or that you sign off for the rental institution, whoever it is that's trying to rent to you, to look at your credit score, and that's going to be a determining factor whether you get housing or not, that rental unit or not. Transportation, we're talking about when purchasing a car. Employment, it's said that now that approximately maybe 70% of employers are now looking at credit report or credit scores, and also having that be a determining factor for employment. It used to be a lot more with industries where you were dealing with people's money, like banking, retail, but it's becoming a lot more prevalent now that employers are looking at credit score as a way to determine character, how you use your money. Banking, any type of banking product. Utilities, for these type of services, they're going to want to see your credit score, your credit report, and most definitely they'll want to know if you have not paid on time any other account that you've had with them. Any type of borrowing, and in order to lower your premiums when it comes to insurance premiums. So these are just some of the very common, important ways that people are starting to realize that they need to have a good credit score for, and that without this, regardless of income, it limits your access to these type of services and opportunities. Another one that's not mentioned on here that I see a lot with my clients are people who are looking to be co-signers for their children's student loans. They also then need to have a good score and a good credit history in order to be able to do that for their children. So that's something also to think about. And then in the context that we're talking about today, most definitely to start establishing yourself with your business. Now, what everyone wants to know is what actually impacts my score the most. What can I do, or what have I been doing that has an impact on my score? So here is a breakdown of what impacts your actual credit score and in what order. So your payment history impacts your score 35%, amounts that you owed 30%, length of credit history 15%, types of credit 10%, and new credit 10%. So then payment history literally means that paying on time. And usually what impacts the most with paying on time and not on time is revolving credit, which is our credit cards. Amounts owed refers to how much do we owe versus how much credit we have available to us. And then again, what impacts that a lot is also our credit cards, because it's the one type of credit that most of us have in common, that is very common. Most of us have credit cards, and a lot of the problem sometimes with debt comes from credit cards, and it's because of this, because we are either maximized already on the limit or very close to, or for some people have already gone over whatever their limit was on those credit cards. And we're going to talk a little bit more about that in a little bit. Then length of credit history is 15%. Length of credit history means how long have you had those lines open for. So some of you may have heard before when people say to whether or not to close a credit card. This is one of the reasons why you want to be careful of closing a credit card depending on what that credit card shows. So for example, if the oldest card that you have is with Target, for example, that you opened like 10 years ago, you've always paid on time, you have never had a late payment, you have never gone over your limit, you've always kept your balance down, this is something that then will show up on your credit report and show a good credit history, and it's showing it for a significant amount of time, right? 10 years. So you would want to be careful and not to close that, because once you close that, then you have nothing else that shows, or if that's the oldest one that you have, you would have nothing else that shows that good history for that amount of time, right? So length of credit history means how long have you had these open, and the longer you've had something open that shows positive credit history that you still have active now shows best on you, okay? So it's the same way I give the example to my clients when we're doing this class. If I were to tell you, you're still contemplating from the very first question I asked, if you're going to lend out to me, all you know is that I work for the Resurrection Project. You don't know yet how long I've been working there or not. And I tell you that I have a Target, the only thing on my credit report is a Target card that I opened yesterday, versus someone else that you're contemplating to lend to, and they tell you that the only thing that they have on their credit report is from 10 years ago, and you're able to see that this person has been able to pay off this for the last 10 years, always on time, never gone over her credit limit, versus me, who only has 1 month to show for, right? So in that example, you can see if you're thinking of lending out, which person are you most inclined to go with? The person that only has 1 month to show for themselves, or the person who has like 10 years, right? So that's why it's important to always be careful on, if we need to close anything, that it not be the one that can show the best history for us. And if we don't know that, we might end up closing a credit card that is the one that we've had for the longest time, and it's the one that can show that we've been able to pay off always on time and always keeping our balance low. Types of credit talks about the installment and the revolving, right? So that's 10%. And then new credit is anything that you've recently opened, okay, that it's still considered new. So that's the breakdown of what impacts your score the most. So just based on this breakdown, if you leave with anything out of today's presentation, then it's absolutely paying on time, right? Payment history is 35%. And amounts owed, keeping your balances low. Those are the two main things that are going to help boost your personal credit score the most, especially when we're talking about credit cards. Well, actually, when we're talking about credit cards. Paying on time and keeping your balances low. It's also important to know what kind of factors do not play a role in our credit score. Age, gender, national origin, type of income, race, religion, marital status, and income level. So whether I'm 18 or whether I'm 30 has nothing to do with my score. The type of income that I make, so if I make cash income, if I make wages, has nothing to do. Income level has nothing to do. So I can be the CEO or I can be the front receptionist. It has nothing to do with how much you make. It has to do with how you handle your credit. So based on the previous slide, it has to do with if I pay my payments on time and if I maximize or not maximize the credit that I have available to me. Okay, so then here's the range for the credit score and what's considered bad, what we call bad, fair, good, or excellent. It's important for you to know where you fall, and it's also important for you to know, depending on what it is that you're looking to improve your credit score for, in our case, potentially getting a business loan, where is it that my score needs to be at, right? So anything between 620 and 300 is considered bad or not so good credit. Fair is anything between 680 and 620. Good is 680 to 750. And then anything over 750 is then considered excellent. Okay? So this gives you a good idea of the range, where you fall right now and where you need to be. A lot of people want to know how soon can you get from bad to good or from bad to excellent. It is on a case by case because it depends on what you already have on your credit report and what you currently have. So there's no magic number, there's no magic key to how fast things can happen, and it's definitely on a case-by-case because, for example, to give you an example, in our experience, we have a program to help people establish credit if they have no credit, and they have had one line of credit, and within a year, they went from having no score to having a 700. So they're already at good, right? But this is somebody who had nothing on their credit. So is it possible to go from nothing or from bad to good within a year? Absolutely. When you're trying to reestablish yourself, it's a little bit different. So somebody who already has negative items on their credit report and are trying to reestablish themselves, not only is it also going to take time, but it has to do with what is it that is already showing up on your credit report that's negative and what needs to be done. Is something being done to rectify that or not? And we're going to talk a little bit about that. But I just wanted to mention, since I'm showing you guys the range, it's good to know where you are and where you have to be, but also in the context of how soon am I looking to get from one to the other. And it's going to be on a case-by-case. So for people who need to establish credit because they have none, credit works in the same way that experience does when you're applying for work. If you have no experience, then you're not going to get the job. If you have no credit, you're not going to get any credit extended to you, any traditional credit. So then there are options for those who either A, have no credit to show for themselves, or B, have negative credit scores and are therefore not being eligible for any type of traditional credit. So there's opening a secured credit card, opening a secure loan or applying for a secure loan, and then a program that we call Lending Circles that was actually initiated by a nonprofit in San Francisco called MAF, and the Resurrection Project in collaboration with MAF is actually providing this to our clients as well. So I'm going to break down how a secured credit card works. Most big banks have them. Most credit unions and community banks have one. There may be some major banks that might not have it, but if you already have a bank that you bank with, or if you have a community bank or a credit union in your neighborhood, it is worth finding out if they have a secured credit card, and they most definitely probably will. So secured credit card works. We talked in the beginning on what are the 4 things that a lender looks at, right? One of the things is collateral. If you have no credit, if you have no credit report to show for because it's either negative or you have none, then there's nothing that a lender is going to base themselves off of to determine to extend credit to you, which is why they will continue to deny you. In a secured credit card, you are building your own collateral. You are giving the money up front, and usually it's anywhere between $300 to $500. There's some banks that work solely online and don't require a minimum, so it's good to research the options that you have, but you are putting the money up front. And usually the way that they work then is that if I'm dealing with a banking institution, they'll go ahead and take that amount that I'm giving them. They're going to freeze it in an account, and then they're going to go ahead and give me a credit card, right? And that credit card I start utilizing as a traditional credit card, knowing that my limit is that amount that I gave up front. And I continue to use it. So usually within using it 8 to 12 months, if I've used it well, paid it always on time, then the bank goes ahead then and gives me my money back and then extends to me an offer for a traditional credit card. So a secured credit card is a foot into actually stepping into getting a traditional credit card when you are not quite there just yet. Okay, so that makes sense. If right now I have no credit, therefore when I apply at Marshall's or at Best Buy, nobody gives me a credit card, or if my credit score is so low that no one is giving me a credit card, how do I then start reestablishing myself? How do I start showing that I can open an account and pay it on time? Well, then I need to then put the collateral down. I need to create that collateral. So with a secured credit card, that's exactly what you do. You're putting the money up front, and that's you creating the collateral. And then you start using that secured credit card as if it were a traditional credit card. You use it monthly, pay it off monthly, and then each month that I'm paying, they're reporting to the credit bureaus so it shows up on my credit report. And the more I have positive history, so payments that are showing up on time, then eventually they're going to go ahead and return my money back. And usually it's within 8 to 12 months, depending on the bank. They're going to give me my money back, and they're going to go ahead and offer me a traditional credit card. So I have now just opened the door to myself to be able to A, establish credit if I had none, B, reestablish myself if I had negative credit, and now I'm going to go ahead and receive an offer for a traditional credit card. And then with that traditional credit card, you continue on using it, paying it off on time, not maximizing your limit, the amounts that you owe, and then that way continue to establish and keep a positive credit history, helping boost your score. The secure loan works in a similar way depending on the bank. So usually, again, you want to do your research on who in your area provides these secure loans and ask all the questions on costs, interest, any type of fees so that you can compare apples to apples. We usually tell our clients to look at 3 different institutions and compare those 3 different products so you can compare apples to apples. And so the way that they usually work is, again, you're either going to be giving a monthly payment until you have accumulated the full amount of the loan that you're going to receive, and each time that you're doing that monthly payment is reported to the credit bureaus, or the amount is given up front to you, and then you're then left making those monthly payments, and then that's what's reported to the credit bureau. So these are the 2 most common ways that you can start establishing yourself or start reestablishing yourself if you already have credit and it's negative credit, so that you can start showing that you actually have good positive history. Now, very quickly, Lending Circles is, again, the program that I mentioned that we have in collaboration with another nonprofit organization, which works very similar to a secure loan, where you're making a monthly payment a month, and it's reported to the credit bureaus as a secure, as an installment loan. And so in that way, it's able to help you establish credit. There is no fees linked to it, so there's no interest and there's no fee. It's basically a way for you to save and establish credit. So at the end, if you are interested in that, we do provide that, and it's another way to be able to establish credit. So you can let me know if you have any more questions about that. Another thing that's important to mention, if you have any other type of bills that you're paying on time that do not show up on your credit report, it's important to keep those up to date, just because if you end up working with a smaller bank, a community bank, or a credit union, they may accept other items as proof that you pay on time, even if they don't appear on your credit report. It's important to note, though, that most major big banks do not. They only go by what is on your credit report. But if, for whatever it is that the transaction that you're dealing with a smaller bank, a credit union, or a community bank, they will make it known if they accept anything other than what's on your credit report. In which case, if they do, then it is important for you to make sure that you have everything else that you pay monthly paid on time, and that you're able to receive proof of that. So anything like utility bills or a cell phone bill, insurance bills, rental, anything that you can get in writing that states that you have paid your last 12 months, for example, on time. But again, most major banks are not going to accept that. We just mentioned that because if you're dealing with a smaller financial institution, they may take that into account. Another way for you to be able to establish credit is to be an authorized user, or, like I mentioned in the beginning, a co-signer for a loan. So this we leave at the end, along with purchasing a furniture or an appliance, because these are, although sometimes these are the first things that people think of to establish credit, they're going to be the ones that we mentioned but will not encourage. So why will I not encourage authorized user? The same thing that I said in the beginning. Authorized user is different than a co-signer. Co-signer means that you signed off and you are both liable, like I said in the beginning. Authorized user means that the person who owns or who actually signed for the credit card, for example, or for the loan, has then called in and asked to have you be an authorized user. If it's a credit card, that means that you're going to go ahead and receive a card under your name, but it's still that same account that the person has, And so now you just received access to using that account. It's now going to appear on your credit report, but you are not financially liable, okay? But it still will show up on your credit report. So that means now that two people have access to this account. It impacts both of these two people's credit report and credit score because it's showing up on both of yours. But only the person who actually signed for that credit card is actually financially liable. So the reason we do not encourage this is because you have no control over how that other person uses that account and vice versa. And if up until now this person has always paid on time and it has helped your score, then that's great. But if something were to happen where that person cannot continue paying, and technically you are not liable to pay, so you do not pay or you're not able to pay, then now that negative credit history is now on your credit report, and it's going to start impacting you. So this is why, excuse me, it is definitely a way that you can start establishing credit, but not a way that we're going to encourage because you have no control over how the other person uses credit. And just in the way that it can help you, it can also impact you negatively. The last one that a lot of people also do is applying or purchasing an appliance or some furniture. Now, unless you absolutely need that and you are sure that they are going to be reporting to the credit bureaus, then yes, absolutely. But if you're doing that because you think that's the only way you're going to establish credit, you now know that it's not. So the number one, the easiest and the most recommended way is for you to go and get a secured credit card or a secured loan. It's important also to note that if you're getting an appliance or furniture from like a local mom and pop store, they may not report to the credit bureaus. So you may end up doing this thinking you're helping yourself, and it may not even be reflected on your credit report. So it's always important to note that if you are doing that, that you ask if they report to the credit bureaus. Because if they're a smaller company, they may not. Okay, and here we just go, I'm going to briefly talk about non-traditional credit because I've already mentioned it. If you're dealing with a smaller lender, not one of the bigger banks, these are the types of things that they may consider as proof of you having positive credit history, of you paying on time. Electric bill, gas bill, rent, child support, car insurance, any other consistent monthly payment that shows that you are paying on time, that shows a credit history. Usually banks want to see the last 12 months. So banks have their list or their own list of what they consider acceptable alternative credit, and these are usually credit unions or community banks. It's not going to be the major banks. Okay. So now, based on what we talked about in the little pie chart graphic of what impacts your score the most, we just want to recap then, what is it that's going to help you maintain a good credit score? Paying your bills on time, and when we're talking about most definitely credit cards, what's important to know about paying bills on time and paying credit cards on time is that you want to make sure that you are looking at the fine print of when that payment is due, by what time it's due, and depending on the credit cards that you use on your bill, it'll tell you usually a time frame, like what time it needs to be paid by, and a time zone. So you want to make sure that it's 5 o'clock Central Time. If it's not Central Time, if it's Eastern or Pacific, then you want to make sure that you're making that payment before that time, right? Because if it's Eastern Time and you're still thinking that it's Central Time, you end up paying it not by 5 o'clock Eastern Time, then it is already considered late. So you want to make sure that you are looking at the fine print, because once you make one late payment, and I believe this is going to show up in one of our other slides, once you make one late payment, that one late payment will then show up on your credit report. We mentioned that, right? It shows what payments you've made on time, and it shows when the payments have been made late. Once it shows up that you've made a late payment on an account, that will remain, that history will remain there, and it will remain as negative, or what they call derogatory history, for the next 7 years from that first payment you made late. So it's important to know the gravity of making just, even if it's 1 day late, when it comes to credit cards, just making one payment late then removes that account from positive history to negative history for the next 7 years. So it's important to note how important it is to make those payments on time. Then do not max out your credit limit. So keep your balances no more than 30% of your credit limit. So that's going to be the other rule of thumb. A, paying your bills on time. B, when we're talking about credit cards, revolving credit, you want to make sure that your balance is no more than 30% of what your limit is on that account, okay? So if you've already gone over, if your balance is already 30% of your limit for that card, that may be an indication of why your score may be low. As soon as we go over that 30%, our score starts to decrease. When we're talking about credit cards, even if I'm making my payment on time every month, but if I already owe more than 30% of what my limit is, then my score starts to go down. So that is one of the easiest things to pinpoint when we're sitting one-on-one with someone and we're looking at their credit report. We go line by line down to make sure that everything on their credit report is accurate and correct. And then we take a look at the credit cards and we take a look to see where is your balance. Is it already over 30%? So then we go ahead and we calculate per each card what that 30% is. So that is our target, bringing it down lower to 30%. As soon as you start bringing it down to the 30% or lower, your score starts to go up again, okay? Because this is going back to amounts owed. Excuse me. This shows that not only are you being able to make your payments on time, but you know how to manage and use that credit that is extended to you. Anything using or owing at the end of the month more than 30% of your limit demonstrates that you are getting close to maximizing or maximizing the use of the credit that is extended to you. So as long as you stay under 30% of that, of whatever the limit is on that card, then your score will not suffer. And if you already are over that 30%, bringing it down is what's going to help you boost your score. Now, depending on how many accounts you have that may or may not be over, you may not be able to do all of that at the same time, and that's okay. So, for example, when we meet one-on-one, or if you're not meeting with someone one-on-one, where you're taking a look at your own credit cards, you just determine what that 30% is, and then as long as you slowly start tackling each card one by one, you're going to start seeing your score increase. Excuse me. Paying your utility bills on time in case you need alternative credit. As we mentioned, if you're dealing with a smaller lender and they do accept any other type of proof that you pay on time, then you want to make sure that you have paid everything else on time so you can have that to show for. Annually review your credit report. You want to review your credit report once a year because now you know that you are able to do that free, and I'm going to find that link for you on these slides. You're able to do that for free. You're able to look at the 3 credit bureaus information on what's showing up on your credit report. And it's important to do that annually, not only for those who are tracking their score and want to improve their score, but even if you're not looking to improve your score, it's important for you to look at your credit report annually because there are people who have things showing up on their credit report as a mistake or as fraud and have no idea up until they actually need to use their credit. So if you're trying to apply for a loan and that is the first time you've seen your credit report or your credit score in the last year, 2 years, there might have been something showing up as a year ago and you were not able to do anything about it because you were not aware. You only become aware at the moment that you absolutely need your credit. And now it's going to take time because now you're going to have to address whatever's showing up on there. And that's what usually ends up happening with the clients that we end up meeting. So we have parents who apply for a loan to co-sign for their child that's going to be a student. The loan gets denied because something showed up on their credit report that they had no idea showed up. Or somebody's getting ready to become a homeowner. They go and try to get pre-approved at a bank. They get denied because all of a sudden these things show up that they had no idea about. So this is why it's important, not only if you're tracking, let's say that you are good with where your credit is at, you don't want to track anything, but you do want to take a look at it on a year-to-year basis because anything can change. So I have clients who told me, well, the last time I saw my credit report was 2 years ago and everything was fine. Within the last year, things started showing up on her credit report that were not hers, that were a mistake, that it was not fraud, but it was just a mistake on her. But as a result of those showing up on there and her not being aware, she got the loan denied as a cosigner for her daughter's student loan, right? So the consequence of not knowing what's on your credit report and having it affect you negatively are very real, as in not getting a loan for education, right, or not getting a loan for, the home, or ending up paying a much higher rate for your car loan because something's showing up on there that's making your score lower than it necessarily should be. Okay, so that's why it's really important, even if you're not working towards any specific goal, that you take a look at your credit report annually. Now, it's not going to show you your score, but it will show you your information. And then if you meet with someone one-on-one, as a financial coach with any nonprofit organization or anyone that helps you review your credit score, in our case, we are going to be able to see your score. And with the clients that we meet at least for 12 months, and then we're able to monitor that information for the next 12 months. These are a lot more common sense, right? Store your personal information in a secure place. Use credit cards as a last resort if you need funds. So that's just referring to using your credit cards only as needed, because we want to make sure that we do not maximize our use of the credit that we have extended to us, and that we use it responsibly. So remembering that credit cards are short-term loans. They're not additional income. They're short-term loans. So using them only when it's a last resort, so unless we actually know that we're going to be able to pay them off. Instead of what usually ends up happening with a lot of us is that we end up using it for bigger purchases that we know we can't afford right now. So depending on the necessity of that, if you're purchasing a ticket, right, for a flight, well then absolutely yes, you may not have the cash for it right now. You use that just as long as you know that you're going to be able to pay this off for what you're using your credit card, so that you don't end up then getting into debt and not being able to pay off that amount that you used on that credit card. Opening new accounts only when necessary. So why is that? Same reason that we mentioned in the beginning. Every time somebody's looking at your credit report, it's going to ding your score. It's going to lower your score. So in that case, while knowing that, then we know that we're not going to apply for any credit account unless we absolutely need it. And now we know that we don't need more than 2, the most 3 lines of credit to be able to establish or show positive credit history. So the more, sometimes people think that the more credit cards they have or the more accounts they have, the better that is for them, or the sooner they're going to be able to increase their score. That's not the case, right? It doesn't matter how many accounts you have. It has to do with how you use the ones that you have. So in the beginning I mentioned I had a client who had no type of credit, opened 1 account, and in 1 year with that 1 account had a 700. So depending on what it is you're going to need your credit score for, your credit report for, different lenders might ask that you have 2, 3 credit lines. It all depends, but as long as you have 1 installment and 1 revolving, that should be enough for you to be able to show a year's worth of positive history, paying on time and keeping your balance as well. So knowing that you don't want to say yes to every time somebody asks you if they can look at your credit report to give you a credit card for whatever store. The other important thing is take action to reestablish a damaged credit. So the reason that the Resurrection Project and WBDC decided that it was a good idea to do a class like this for their clients is because they had someone tell them that they had a bankruptcy about 20 years ago, and they thought that they still had bad credit. Okay, so anything negative that happens on our credit is going to have an immediate impact, like somebody looking at our credit report, that late payment, most definitely things like bankruptcies, foreclosures, and things like that. But it's important to know that while it has a negative impact immediately, and it might have for quite some time, it is important to start reestablishing yourself. And there are ways to reestablish yourself, such as a secured loan or secured credit card, so that when whatever negative is going on either falls off or stops having as much impact, because let's say it is a bankruptcy, right? And now it's satisfied, it's dismissed. The bankruptcy is over. It's still showing up on your credit report, but once it's over, it's not having the same type of impact as it was while it was still active, while it was still in process, right? So let's say that that's all you have on your credit report. You did not do anything else. You did not open any secured credit card. You did not open a secure loan. You didn't do anything else to show that, yes, I had this negative event happen, but here on the other end, I'm showing you that I'm able to pay on time. If you didn't do anything, then there's no way for your score to recover, for you to be able to start building positive credit history, to be able to boost whatever score you may have left over. Sometimes people think that they can't do anything until after whatever negative happened. It depends on what it is that is going. It might be a bankruptcy, it might be a judgment, it might just be late payments on credit cards, it might be you are behind on your mortgage, or you're behind on any other type of loan. Many different negative things can be happening. That does not mean that at the same time, if you are able to, you can't start reestablishing yourself, right? So with a secured credit card, that means that you're going to an institution. They are not looking at your existing credit score to determine if you're going to get that secured credit card. Why? Because you are putting up the collateral. You are giving the money. So then you start using that, and while this negative item is still working itself out, whatever it is, either you're going to have to pay it off, either you have to wait till the bankruptcy is dismissed, whatever the case might be, you have to wait till you get back current on it and you're not past due anymore on that account. Whatever it is, while that's happening, simultaneously you are already opening something else to show positive credit history. So it's important to know that you can and should reestablish yourself and do not have to wait until after that negative item is done with. Okay? So here we're going to go a little bit more into what those negative items can mean. Like I already mentioned, too many inquiries. So that means every time that somebody asks if they can look at your, or if you'd like to apply for credit, you say yes. You're basically saying, yes, you can look at my credit report, you can look at my score. So too many inquiries has a negative impact on us. People always ask me, why is that? Why does it matter who looks at my credit report, who looks at my score? Why does it have a negative impact on me? In that first, and the example that I give is, in that first scenario, I asked if I could, if you would contemplate lending to me, and you just met me, right? And so usually I have a room full of 15, 20 people, and I show them, if I start with the first person in the room and I ask for that loan and she says no, or he says no, and then I step to the next person and they say no, and then I end up getting to the 20th person, the very last person in the room, by then that person has already seen that I asked everyone else for credit, right? That last person, usually I ask them, so are you inclined to give me that loan or not, just based on the fact that you saw me ask everyone else? They usually nod no, right? So when the lender is looking at me to see if they're going to extend credit to me, we already saw the things that they look at: collateral, character, capital, capacity, right? They're also taking, what they're determining is the risk. How risky am I? And is it in their best interest to lend to me or not? If they see that I'm trying to take out credit with every other person that allows me to, then I look like a risk. In that room full of 20 people, if the 20th person just saw that I asked every single person before them for a loan, they're going to think, absolutely not, I'm not going to lend to this person, right? So that's why, that's the simplest way that I can explain as to why inquiries have a negative impact on us. Because if we take a look at it from a lender's perspective, if we take a look at it, if I'm trying to determine if I'm going to give credit to someone or not, and I see that this person is trying to take out credit with every possible institution, that looks a bit risky, right? It looks like this person is either trying to access credit very desperately for whatever reason, or they're going to have access to a lot more credit. And as a lender, I'm going to then want to think, do I want to extend credit to this person or not? So that's why inquiries don't look too good on us, and we want to make sure that we keep them to a minimum. Large credit limits, same thing. So we talked about not maximizing the credit that is extended to us. Using it responsibly is making sure that we use it no more than 30% of what we actually have extended to us. Again, if a lender is looking at me and I give two scenarios, the person who has that one card from Target has had it for 5. The first scenario was they've had it for 10 years, and the other one I just got, right? In this case, we're not going to be only looking at how long they've had it for. We're going to take a look at what their balance is, right? So if I give you scenario A with the person with the Target card who opened it yesterday, and they have a balance of 0, and the person who has it for the last 15 years, but their balance is $9,000 and their limit is $10,000, right? So what does that mean? That they're already at or very close to reaching their limit versus a person who has the same amount, $10,000 available to them as a limit, but has a zero balance. If you're contemplating lending out to someone, who are you more inclined to lending out to? The person who has a $10,000 card and has a zero balance, or the person who has that $10,000 card and owes $9,000, right? So we want to make sure that we keep our credit limits, our credit balance. Oh, so that's a typo. Excuse me. So keep our balances low. Okay. Collections. So that is another thing. Collections and bankruptcies are things that are going to impact our score. Collections, why? Because by then, the person that we originally owed is no longer the person that's trying to collect from us. It's this other entity. So we want to make sure that collections we deal with, because we want to make sure that at that time it's already with a collection agency. There are ways that you can negotiate so that you do not have to end up paying the full amount and are able to go ahead and settle that so it shows up on your credit report. It's still going to show up that there was a collection, but it won't show as if you owe. Okay? Bankruptcies, there's two types of bankruptcies, and each one works a little bit differently. We don't get too much into bankruptcy because that's a legal realm, but just know it's going to have an impact. Only because you've had a bankruptcy on your credit report does not mean that all is lost. It depends on how it shows up. Is it still in process? Is it dismissed? And are you able to start reestablishing yourself while all of that is being figured out? And usually with opening a secured credit card, you are. But it's important to know that none of these things are forever permanent on your credit report. They will remain there for a certain amount of time, and I believe that is the next slide, yeah. So the very last thing that's on this slide is any information about a lawsuit or judgment. So any lawsuit or judgment also will impact your score negatively. But here gives us a breakdown of how long will that stay on our credit report. So late payments, so like I said, that credit card that you had that you made one late payment on, it's now going to show up as derogatory or negative history for the next 7 years from that first payment that you paid late. Bankruptcies, depending on the type of bankruptcy, is going to show up on your credit report between 7 to 10 years, depending on the type of bankruptcy. Foreclosures, 7 years. It's going to show up on your credit report. Collections, 7 years, depending on the age of the debt being collected. So collections is a little bit tricky because what counts is the time, even if it's with the collection agency, the clock starts ticking from when you originally paid late, the first late payment. So the collection agency does not start the clock all over again. So it's important to know when was that last, or the first late payment, so that you know that within 7 years that should be falling off, no matter who the account is with by then, no matter what collection agency it's with by then. Public records. So that it's 7 years. So most, as you can tell, most negative information is going to come off within 7 years. The ones that are trickier are public record because it depends on what it is. It depends on if it's a judgment or a lawsuit. If it's already a judgment or a lawsuit, it does not come off after the 7 years automatically. Depending on who you owe, it will not come off of your credit report until you pay it off. Okay? So once a debt becomes a judgment or a lawsuit, depending on who you originally owed, there's not much you can do about that. But 7 years and waiting 7 years for it to fall off, or 7 years so it no longer shows up, doesn't necessarily apply to that. Because depending on who you owe, it will remain on there until you owe. And in fact, then they can take legal action against you to ensure that they get their money back. The way that something that has not reached a lawsuit or a judgment yet may not do. So if you have an account showing up in your credit report that it's not a judgment, it's just not been paid, and it's been over 7 years, and they did not pursue you legally, they did not file a lawsuit, they did not file a judgment, then that will come off after 7 years. But if it's already proceeded, if they've proceeded already legally against you and made it a judgment or a lawsuit, then just know that the 7-year rule does not apply then. Okay? And then at the bottom it just states the clock starts running as of the date of the first late payment. And like I said, that includes if it's already with a collection agency. The collection agency does not start the clock all over again. The clock still starts ticking from that first initial late payment. Here we go. So here is the website where you can receive your credit report for free every 12 months, so once a year. And it'll allow you to pull it from Experian, Equifax, and TransUnion. It will not let you see your score. It will ask you to pay for your score, but you are able to see the information. And then if you want to, you can go ahead and pay for your score. But it's www.annualcreditreport.com, and you're able to see your credit report for free once a year. Okay, so here we go into, I briefly mentioned that one of the important reasons for looking at your credit report once a year is because regardless if you're trying to track your score or not, you want to make sure that you know what's showing up on your credit report. And the reason you want to know is because errors and mistakes on credit reports are very common. So not everything is always fraud. Not everything is always something done purposefully or maliciously. Sometimes there's mistakes because names are very similar. There's a common birthday, or social security numbers are very similar. Or there are family members all with very similar names. Okay, so we have had the case of, so the lady that I mentioned earlier who had had her credit report seen 2 years ago and she was fine, went and applied for the loan for her daughter's student loan and got denied because a lot of medical collections started showing up that were not hers. They were her sister's. And how did we know they were her sister's? Because when we take a look at your credit report, remember it shows your name, your date of birth, your social security number. When we looked at her credit report, it shows us what each credit bureau has as your name, your date of birth, and your social. One of the credit bureaus had her sister's name, which is very similar to hers, but it was not her name. So that explained then that all those collections, medical collections that suddenly started showing up, were actually her sister's. And they were in error showing up on her credit report. So her sister didn't do anything. Her sister didn't give her name. She wasn't committing fraud. Her sister didn't do anything. It just so happens that they have very similar names. And her sister's information was now showing up on my client's credit report. So errors are very common, unfortunately. And so that's why it falls then on the consumer, on us, to make sure that we are aware of what's showing up on our credit report. So now there are companies and organizations that charge to help you fix your credit. It's important to note that there are perfectly legitimate companies that can do that. Just make sure that you are wary that if it sounds too good to be true, it probably is. So there's no way that anyone can give you a blank slate. There's no way that anyone can completely make everything negative disappear from your credit report. As I just mentioned, if it's legitimately yours and if it's negative, it will be on your credit report for the next 7 years. So no one can give you a blank slate. What they can help you with is there are organizations that can call your creditors for you, and they try to negotiate, and they try to set up a plan for you, or they try to consolidate, whatever the case might be. Those are the legitimate organizations that charge because they're doing the work for you. Do you need to go through an organization like that to repair your credit? Not necessarily. In most cases, you don't. In most cases, as long as you are aware of what's showing up on your credit report and what it is that you need to do, you can do it completely on your own. And in fact, the clients that we meet with, we empower them to do it on their own. Now, we provide the guidance and and then being able to follow up and check and make sure that things are showing up as they should be on your credit report, because every time that we're able to look at it, it doesn't impact your score negatively. But it's essentially you realizing that you owe this person, that you owe them this much, that it's already with a collection agency, figuring out how much it is that you can pay off, and then calling and paying it off and asking for proof, for example, right? So that you can do perfectly on your own. Or realizing that there's something on your credit report that is not yours because you know that you never had an account with U.S. Cellular, for example. So in that case, there are ways that each credit bureau has the possibility for you to dispute that and to say why. And you can say this account is not mine. In the case of my clients, there's also a way that you can say, you know, this is a family member or a friend's account with a similar name as mine. Now, I believe the 3 credit bureaus have a way for you to be able to do that directly online. There's only one of them that I believe might be either TransUnion or Equifax that doesn't allow you to do it online unless you have a police report. So unless it's actually identity theft, they won't allow you to do it online. But 2 of the credit bureaus allow you to pull up your credit report through them online, or if you don't pull it through them, you can still go on there and say, I'm trying to dispute items on my credit report, and say what they are, why you're disputing them. This is not my account, or this is somebody else's account. I never had an account with them, or I already paid this off and it's still showing up as not paid. You're able to do it all online, and you're able to do that yourself. So this is why I say you don't have to pay anyone. Now, there's people who prefer to pay someone so they don't have to do all of that on their own, and that's perfectly legitimate. But just know that you have the option of doing it completely on your own, not paying anyone, or you can work with a nonprofit that helps guide the process and helps you take a look at your credit report, break it down, understand it, and then determine, okay, what are the next steps? And then you as a client determine what is it that you're ready to start doing, right? So one of the conversations I just had earlier with my client that I met with one-on-one is that when we take a look and we sit and we look at your credit report, a lot of things come up, right? Things that you may have not dealt with in a long time, things that you forgot were there, things that you did not know were there. So it can be a bit daunting, and it's a lot of information. As you can tell from this presentation, it's a lot of information. So you need to be ready to take action. And if you're not, then you know that's your prerogative. But know that if there are things that are showing up on there, you can most definitely do them on your own. You don't have to pay anyone. And if you have a nonprofit partner that you're working with, they can help you. They can help guide you through the process, right? That's what we're here for. And then here it tells you can contact creditors, directly if to be able to identify any error. Okay, so you know what? I think I'm going to go ahead and stop here. The rest of our presentation goes a little bit into, or not a little bit, goes a lot more in depth with credit cards. And I don't want to start something we're not going to be able to finish. So I will just jump to our recap on how to use credit cards responsibly, as I mentioned before. So making sure that you're paying off your credit card every month. Now, we would encourage that you pay them off completely every month because you're avoiding paying interest. So you're basically borrowing for free. If you're not able to do that, then you make sure that you're at least paying your minimum payment, always keeping in mind that if you've already gone over that 30%, that you try to bring that as close to that 30% or as close to the 30% or below as possible, because you know that once you've started using or your balance is over 30% of your limit, your score starts to suffer. If in need of cash, using your credit card should be the last resort for the same reason that I mentioned earlier. You're using it as a short-term loan, not in the case of extra income. And that's how you're going to ensure that you do not, A, get into debt, and B, start having your credit score suffer. Because if you're not able to pay it off, eventually that balance is going to go over 30% of your limit. Once that happens, your score starts to decrease. Avoid paying any late payments or over-limit penalties. So some credit cards will allow you to go over the limit, but they'll allow you at a cost. So then all of a sudden your interest rate hikes up. So you're paying a lot more interest for the amount that you owe, and your score definitely suffers. So if you're over the 30%, your score starts to decrease, let alone if you've now gone over the limit, your score starts most definitely decreases. Don't give your credit card numbers over the phone unless you made the call. So that's just for privacy and for security reasons. Of course, unless you are the one initiating a phone call, you want to make sure that you are not giving your information over the phone to anyone. Review your monthly statements and cross-reference with your receipts to ensure no overcharges or mistakes. So when using credit cards, it's just almost like when we're talking about your actual credit report. You want to make sure that you stay on top of your finances and that you take a look to make sure that there has been no mistakes or anything on there that's showing up that you're not aware of. That's also going to be the best way for you to stay on top of any type of fraud or anyone trying to use your card, because that's unfortunately nowadays also very common. And unless you have a credit card that alerts you or will give you a notification, somebody might be taking money out of your account from another state and you might have no idea unless you're taking a look at your statements and your receipts. Again, report any lost or stolen credit cards. Only carry credit cards as needed for the same things that I keep on mentioning. And of course, never share your credit card info or PIN with anyone. Okay, so I think I just about reached the time that we wanted to go ahead and stop at to give opportunities for anyone to ask any questions or any further explanation or elaboration on anything else that I said. So Natalie, I don't know if you want to go ahead and...
Sure. So we've actually got a few questions on the chat. So if it's okay with you, Madeline, I could just give you around 2 to 3 from the chat. One of the questions that we had, was one of the first questions, was what alternatives, if any, can we use to minimize credit inquiries when considering purchases like a car, a school loan, housing within the same time period? So just some tips on how to minimize the effect it has on your credit if you are considering opening credit lines at once.
Okay, I'm sorry. You're going to have to repeat that. So what type of impact, how to minimize the impact of?
So how to minimize the impact of multiple credit inquiries. So if somebody's, you know,
how to minimize. Okay. Okay.
Right.
Okay. So I think I see it here. So if you know that you are taking out, going to be taking out all these types of different loans at the same time, unfortunately, if it's different types of loans, so if you're going to be taking out a car loan and a housing and a student, you want to make sure that you know what the repercussions of all of that will be, depending on what type of loan it is that you're getting out and what the priority of those loans are, like which one is your priority. And the reason that I mention that is because if you're trying to get out a mortgage, the bank is going to take a look at what other existing debt you have. So if you are thinking of taking out a mortgage and then you're taking out a car note at the same time, that might have an impact of whether or not you qualify for a home loan or not, right? So that's not even talking yet about the implications on your score. That's talking about implications on eligibility. So big purchases like mortgage, student debt, and a car note, if you're doing those all at the same time, you want to make sure you know what your priority is of what it is you absolutely need and not, and what the implication is going to be on your eligibility on everything else based on what you end up getting first. So if you get the mortgage or in process of trying to get a mortgage, is getting a car note going to impact me or not allow me to get that mortgage loan? Do you know what I mean? So those are things that you might want to talk to a professional before you go ahead and do them, so you know what the implications are. And at that point, I'm not even talking about scores. But let's say that you are trying to get a mortgage and you are going to want to go talk to 3 different banks. When you are doing a purchase like that, a home mortgage, there's actually a window of time, and I believe it's 60 or 90 days, where you can go to several different banks, and when they're looking at your credit report, it will not affect your score each and every time that they are looking at it. It'll only show up once because they determine that you're a homeowner or somebody who's looking to become a homeowner, and you are going to several different banks. to get pre-approved, for example. So that will not ding you each and every single time that a bank looks at you. It'll only ding you once. So there is a window of time. When it comes to car notes, you want to be careful because every single time you go to a car dealership, they are reviewing your credit score or your credit report through all the different financing options that they have, which might be 6 to 8, and then it'll show up on your credit report as 6 to 8 people having looked at your credit report in one day. So that is a lot to say that if you're getting all of these different types of loans and they're big purchases, there's no way to minimize the impact. Unless you're looking to become a homeowner and you're applying for a home loan and you're going to 3 different banks, in that case they allow you a window of time so that it doesn't ding you every time you go to a bank. But if it's a car note, a home loan, and another big purchase, there's no way to minimize. And in fact, my concern in those cases would be that you make sure that you talk to a nonprofit organization that will tell you, if you end up getting a car right now, that might impact your possibility of getting the home loan, or vice versa, whatever the case might be. I hope that answered it.
Great, thanks so much, Madeline. And I actually have, I have a couple of questions that I think could probably be merged together, but it essentially has to do with collections. So the first one has more to do with settling a collection and the way that it shows on your credit report. I know that there are a lot of people who think that if you settle a collection, it looks bad on your credit report when you're trying to obtain credit later on. And then the second part of that is, how does it look and how detrimental is it if you are, making payments on a collection and you're trying to pay it off and have been for quite some time, a few months or so. Is there a way that you can show the creditor, if you're trying to, let's say, obtain a car loan or a mortgage loan, to show them that even though there's a collection, you've either paid it or are trying to pay it off or settled it? Like, how can you show that you've made a payment and are being responsible with keeping up on that, even though it is a collection, or you might have settled it, or you're still working on it?
Okay. So if you have a collection and you're on a repayment plan with the collector, it's important to note that it will not show up on your, for the most part, it will not show up on your credit report as you having that established plan. It'll still show up as past due. What changes is the amount that you're past due. So let's say that you're on this repayment plan and you and I meet today, and as of right now you owe $5,000. That's going to show up. If in 3 months you are still on that repayment plan, but now you owe $3,000, it will not say this person is on a repayment plan. It'll just show that you still owe that collection, but you owe less. Okay? So it's important to know that it depends on where you're at with that collection and how it'll appear. If you're on a repayment plan, it won't show that you're on a repayment plan. What will continue on changing is the amount that you owe. So as you pay it off, then it'll eventually show up as paid. Okay? If you are trying to get a loan and you want to show whoever the institution is that you are paying this on time, it's going to depend on the type of loan and on the bank if they're going to take that into consideration or not. They may not, because it still shows on your credit report as past due or not paid, and you might need to wait until you finish paying it off. But it also may have to do with the amount, right? So depending on what it is that you're trying to get, the bank might tell you, A, you cannot have any outstanding debt, in which case you'd have to wait until you pay it off. Or B, they might tell you, you cannot have any more debt than X amount, right? So they can tell you, you cannot have any more than $5,000 that you owe. And if you owe less than that, then it may not matter. You may be okay, and still they may be able to move forward with you, even if you have that collection that you're paying off, but you owe $3,000, right? It's not $5,000. Or they might tell you, you cannot have any outstanding debt, period. Like, you have to be current on everything. And in that case, it won't really matter to them that you're on a repayment plan. They just want to see on your credit report that it says paid. So it's going to be determined on who you're trying to get credit from and what are their requirements. What do they want to see on your credit report or not? And then, I'm sorry, so that's the response to the second part of the question. Did I respond to the first part of the question?
I believe so, yeah, because we were talking, I think the
Okay.
first part was the settling for less than what you paid and it being very bad, but I think you talked a little bit about how it just really
Oh,
depends on
so
what
okay.
you're looking for.
Okay, so then let's say that you are not in a repayment plan. It's assuming that you're paying off everything that you owe. So if the original debt was $5,000 in a repayment plan, you're making a payment towards that $5,000. So you're going to pay that off in full. If you settled and you paid less than what you owed, then it'll show up on your credit report as paid less than settled for less than owed, or it'll just show off as paid. All that really matters for your score is that it shows off as paid. Okay, so and all that matters for banks when they're looking at it is also that it shows off as paid. It doesn't matter so much that it says that you did not pay it in full, as much as that it matters that it shows up that you no longer owe. So that shouldn't really be a problem. As long as it no longer shows as being owed, then you should be good.
Wonderful. And then just one last question, and this had to do with being in a credit consolidation program. So somebody's trying to consolidate their, what they owe in their credit cards or whatever debt they may have. How would that, affect your ability to inquire, towards your credit report? How would that affect your ability to know what credit score you have and, how you're doing in terms of credit repair?
So that's a good question. You should still be able to see what your accounts are. What it'll show up as is, even though they were consolidated on your credit report, it'll show as the account was closed and that it's being paid off, or that it already was paid off. Because what consolidation basically, what they end up doing is that they end up closing all of those accounts and then putting them all together so that you have one payment, right? And usually if you're going through a company, you're paying them and then they're paying off your debt. But that's basically what they end up doing. They end up coming to an agreement with your creditors that they're going to close the accounts that you have and that they're going to accept a payment directly from this company. So the way that they show up on your credit report, they should still show up individually. It'll just show as closed, and it'll show up if it was paid off already or not. So we should still be able to see them. It's just important for you to know that when they consolidate all your debt like that, it usually has a much more negative impact on your score overall. And it is because what they end up doing is closing all of those accounts. So they end up closing all the access to credit that you have, but you still have all this debt. So it ends up skewing the ratios between how much credit you have available to you and how much you owe. Remember, one of the main things in what makes up our credit score is how much we owe. If all of a sudden we close all these accounts, that means we don't have access to all of that credit, but we still have all that debt. So that skews that ratio, and it usually impacts our score pretty badly. That's not to say, though, that you're still not going to be able to reestablish yourself. It's just important to know that it actually impacts our score, our score in our report pretty badly. But on your credit report, we should still be able to see all the accounts individually. It'll just show that they were closed and that it was either paid off already or it's still not paid off. But you know, if you're in the program, that it eventually will be paid off. And we should be able to see that, and you should still be able to reestablish yourself in the same ways that I mentioned. So getting your secured credit card and your secure loan, or both, or lending circles for that matter, and then just showing positive credit history through that. So then once you're done paying off all of those collections, you're then able to have proof or history of actually making payments on time. So you should still be able to A, see it on your credit report, and B, still be able to reestablish yourself.
Wonderful. Thank you so much. So we're actually right at the time of the end of the webinar. I just wanted to kind of take the time to just thank everyone who tuned in for the webinar. I hope that it was helpful. As you know, the Women's Business Development Center offers a variety of services. I encourage you to go to wbdc.org where you signed up for the webinar and look for all our other events. And just keep in mind that we also offer free counseling to all our clients. So if you want to have a 1-hour counseling session about starting a business, I encourage you to call our office to set up an appointment. Madeline, I did want to ask, is there any way that people can get in touch with you if they're interested in credit counseling and if they want to find out more about your services, how would they go about that?
Oh yeah, absolutely. So you can go ahead and contact our offices and let them know that you'd like to make an appointment with a financial coach. So I'm one of 2 financial coaches, or you can specifically ask for me. So I can give you the phone number where you can go ahead and set up that appointment. It would be 312-880-1137. And so that's the person that sets up the appointments with us, and you can go ahead and let them know that you either A, want to meet with a financial coach, or B, that you want to meet with me specifically, and know that we work out of at least 4 different locations in Chicago and in a western suburb called Melrose Park. So there's going to be, even though there's only 2 of us, there's a couple of several different options where you can meet with us, days and times. And like I mentioned before, our services are free. So we're just going to have you bring some documents in that we need in order to have on file. But other than that, you can definitely make an appointment with us through that number. My email is m as in Madeline, Cruz, C-R-U-Z, at theresurrectionproject.org. So if you have any questions about lending circles or anything else, or if you'd like to, if you'd like me to send you the calendar of the classes that we have regularly on credit or home ownership, or anything else that I mentioned that the Resurrection Project does, you can contact me at my email, mcruz@resurrectionproject.org.
Wonderful. Thank you so much, Madeline. This was super helpful. I know I myself have learned a ton. So we'll go ahead and end the webinar now. As Madeline said, feel free to contact her if you have any thoughts or if you need to meet with her for a credit counseling appointment. And if you'd like to learn a little bit more about the process behind starting a business, feel free to get in touch with us at the Women's Business Development Center. Thank you so much once again, and enjoy the rest of your day.